Thank you. All right. Well, we are excited to have Mike here today. Great webinar. This is a series we do quite a couple times a month, so about twice a month at least. But it's always a pleasure to have Mike on. So investor strategies for any market, and I will say that's 100% true with Mike and his team. They provide huge insight. This is a fun one. If you haven't noticed, obviously the market's been volatile. We have a lot of stimulus spending, things coming into the market, changing the market. So it's always good to have someone like Mike and his team in your corner to kind of calm things down, give you some peace of mind of what's happening. So we're excited to have Mike on tonight. Great topic and great timing. This is part of a webinar series we do, like I said, almost twice a month. Our main event that we do a couple times a year is the 3-day Asset Protection and Wealth Creation Summit. With Mike is a featured speaker at that event. Mike and Stacy are an incredible team there. You'll see some other experts there, asset protection attorneys, estate planning attorneys, investing, advisors, trainers, asset protection and tax strategies. Scott Estel, one of our good friends here, former senior trial attorney from the IRS. Awesome people, awesome team. You're welcome to attend that. We are now, the great thing is, for a lot of you know, that event is now, in the past we've charged for that event, but now because it's live stream, one of the things I think COVID's been a blessing for us is, well, we can do it from your couch, you can do it from your bedroom, whatever you want to do, from the office, at lunch, whatever, you can live stream this, and it makes it very simple. So April 22nd through 24th, you can register at protectwealth.com, or June 14th through 16th. We will have some live events coming up soon. We'll on Orlando in September. We'll have some new dates and different things we'll announce later, but love to have you if you can make it. And Mike, I know we always do a legal disclaimer, a financial disclaimer. I'll kind of let you do that. We're not giving legal, financial, or tax advice, basically. Seek out a competent professional for that. And so I want to introduce Mike. Mike, we've been almost around the world here and there, you and I, on a train in Alaska, on a boat in the Caribbean. I mean, we've done it. So I can say I spent a lot of time with Mike and his team, and I really, really do love working with them. They're good people. I know them well. I can vouch for him all day, every day. Mike's an incredible trainer. I'll let you give some of your background, Mike, but really, as far as the experts out there, Mike is one of the most, sought after speakers, trainers on the market. So Mike, we're really, really glad to have you today. I'll turn it over to you. You should be able to take control of the screen. I want to make sure that works okay. And then Mike, are you planning on answering questions throughout?
I am going to, yes. So if you got some, I got the question and answer on a separate screen over here. So you might see me turn my head over here to look. So I'll do my best to go through some of those.
Okay. All right. And then go ahead and share your screen. I want to make sure that works, but yeah, I know you're fairly handy.
Yeah. So let's go with this one here now.
Perfect.
Okay, great. All right. So welcome everybody. I'm glad to have you guys on here. I do have some things I want to go through here, and hopefully I'll get through everything on time. But I want to say thank you, Kendall, for having me here. And it's always great to be on here because I love talking about the stock market. I will do my best to keep it fairly simple. I know that sometimes I can talk really fast and I can go into detail quite a bit just because I love the stock market. It's what I do for a living, but I'll try to keep it simple because the stock market for the most part can be pretty simple if you want it to be. It's just that you're oftentimes taught to be confused by the stock market, because if you're confused by it, you'll give your money to somebody else. When you give your money to somebody else, they get to make the money. I mean, think about it. We've never been taught, from the time you're a little kid, you've never been taught to manage your own funds. You've been taught to be a good person with good morals and good values and go to school and get an education, get a job, give your money to somebody else. And why are you taught that? Because as long as somebody else has your money, they have control. And no, I'm not saying control of you, but I mean just control of whatever they want because they've got the money. Wall Street pays for everything. Who do you think elects all of our officials? Who pays for all the new IPOs? Who pays for everything going forward? It all comes from the banks and Wall Street. It's because they have the cash. You might have assets and you might have cash in the bank, but Wall Street still controls and owns those assets. So as long as they have those, they can do what they want to do with that money. It's like a bank. When you give your money to a bank, what do you think they do with it? It's your money. You give it to them. They give you your 1/8 of 1% per year interest, and then they loan it back to you at a credit card at 25%. That's a pretty good business for them. And the reason they can do that is because they told you that that's how it works, and you've been taught that that's how it works. Is that the best situation? No. Why don't you learn to be your own bank? Well, because nobody told you that you could, and they made it difficult for you, and they said you have to give everybody else your money. So financial markets kind of the same way. We've been taught to be ignorant about how it works, and it doesn't really need to be. Yes, we can make it really difficult. There's some things that you can do, but for the most part, there's some universal truths that if we all follow, making money in the stock market's not that difficult if you're just trying to outperform the S&P 500. If you're trying to do more than that, then you can kind of step it up and you can do quite a bit more. But just to get to the basics, I want to show you what's available, what it really doesn't cost you, and how much you're paying right now to have somebody else control your money, where you're always hoping that they do a good job and you don't really know what's happening. So I've got the same kind of disclaimers that Kendall kind of went back through here. And all we're trying to say here is that everything we covered tonight is just for education purposes only. I'm not trying to tell you that, even though I'm going to look at some good investments tonight that I think are good looking buys as of today for portfolio analysis, I'm not telling you that you need to go back and buy those tomorrow. I'm just showing you what professionals do and how they approach the marketplace and how you can do the same exact thing. All right, so what to expect in 2021? Nobody really knows for sure. And I talked about this in our last webinar we did with Kendall here back in January. And I said that we don't really know what's going to happen in 2021. Is the pandemic going to be over? Are we going to do more stimulus packages? Are we going to overspend? And you guys understand that every time that we print up money like we just did, that $1.9 trillion, it devalues our US dollar. You guys all understand how that works and what that really means? It means that at some point, nobody's going to invest in the US economy anymore because we can't pay for it, because our dollar's not going to be really worth anything. What entry do you trade in the markets? What entity do I trade in the markets? I use both an S and a C corporation, and I have an IRA and a Roth. So a little bit of both, but they're all for different needs. And so it depends on what you're going through there. And with your asset protection, you can ask, Scott, particularly on that when he goes through and covers that, which one might be best for you. But I use an S, a C, and a Roth and a IRA. So Treasury Secretary. So let's go back and just kind of see how some basic things work in the stock market. And there's no need to be afraid of the stock market. The reason that most of us don't pay attention to it right now, or we're afraid of it, is because we don't know the few basics to it. But I was talking to Kendall before everybody logged on here. That's kind of like driving your car. When you're a little kid, driving the car seems like it's crazy or it's magic, or I don't understand how that works. Let me turn that down just a little bit. You don't understand where all that's coming from. But as you get older, driving a car is second nature. You don't even think about it. You just hop into it and you just go, because that's what it is. Well, stock market's kind of the same way. If you learn the basics, you understand what everything else means. And so I want to kind of cover some of those. So we'll talk about what happens and kind of what you should be looking for over the next year. Because a lot of people say, well, should I buy a house right now? Should I invest more in the stock market? Should I be saving more money? Should I be doing this? It all depends on what you think the economy is going to do. If we think our economy is going to be strong, then you keep investing and going forward with that. If you think there's a chance that we could go into a recession, basically what that means is that interest rates will go up in order to slow down the economy. And when the economy then starts to free fall to the downside, called a recession, which just means people get laid off from their jobs. You don't have money to spend. You can't borrow money. What money you can borrow is going to be at a much higher interest rate. So everything starts to go backwards on us. That would be a recession. So either we're going to go to where it goes positive or negative on us. So here's some things that we want to go back and understand. Currently, Treasury Secretary Janet Yellen says that the U.S. can currently afford higher corporate taxes. Now, we just did a $1.9 trillion supposedly bailout package. And I'm not trying to get political, say it was good or bad for any reasons. I'm just trying to say, as an investor, what does that mean for us? Or even you, if you're not even currently investing, but you maybe have money with somebody else managing your money. So if we have higher corporate taxes, just kind of think that through, that generally means that companies won't make as much profit. If they don't make as much profit, that means that they're not going to be hiring new employees. They're not going to be making as much profit. They won't be having as many sales. People will get laid off. People get laid off, don't spend money, and it starts to go negatively. So if you got higher corporate taxes, that usually means the economy is going to slow down. So if we think about it, we just did a $1.9 trillion bailout package, and now we're talking about maybe we're going to do a $4 trillion one next for infrastructure for the United States, which obviously would be good news long-term, but short-term, how do you pay for that? You can't just print up the money and say, here it is. The money has to come from someplace. So how does the government, if they're going to just print up that money, how do they pay that back? Well, we got two ways to do it. Either taxes, one way. So you got corporate taxes and personal taxes, or print up the money and hope that the Fed will then buy that as a bond, and then hopefully we can sell those bonds to somebody else. So really, what's our expectation? Got to raise taxes, because how else do you pay for something? Corporate taxes, personal taxes. President Biden proposed raising corporate taxes to 28% from 21%. All that seems like it might be negative for the economy, but stimulus checks of the 1.9 should be good for the economy. But where's that going to go with? That's why I say nobody really knows what to expect. But if taxes start to go up and they start to raise corporate taxes and personal taxes, that'll be bad for the economy. The reason that they raise taxes is to pay bills. But when you raise taxes, it means that you personally now have less to spend. You have less to spend. You don't buy as many goods and services. You don't buy goods and services. Companies don't have to hire employees. Companies don't hire employees. Those employees don't have money to spend either. And now it starts to spiral to the downside. And the economy that you see, which is hot right now, aside from a few states, everything starts to go backwards on us. So if taxes do start to increase, the economy will drop. At that point, it doesn't mean that we're in bad shape. All it really means is we have to start looking for defensive sectors. And in every marketplace, there's always a section of the stock market that goes up. And these are called defensive stocks. Defensive stocks and bonds will be what people start to buy when the market goes down. So even though the majority of the stock market goes down, you'll still have stocks that go up. For instance, people always tend to eat more, smoke more, and drink more when they're stressed and the stock market goes down. Those type of stocks go up. So there's always sectors that go up in the stock market. Utility stocks go up because they pay a bond. I'm sorry, because they pay a nice dividend to them. So people buy utility stocks. They don't go up a whole bunch, but even though the stock market might be going down 4, 5, 6, 8, 10, 15, 20%, those stocks might be up 3, 4, 5%, plus pay a 4% per year dividend. So there's always going to be ways we can always invest no matter what the stock market does. So we just have to kind of see which way the market's going to go. If you hear that we're going to start raising taxes, understand that our economy will start to slow down at that point of time. We go through. So now, here's what I want you kind of to look at going forward for the next 12 months. And so if you guys, I know this is going to be recorded. And so you can kind of go back and look at this or just take a screenshot real quick or just write this down as we go through here. But here's what you really want to focus on over the next 9, 10, 11, 12 months, because this will tell you which way the economy is going to go and how we need to react, because there's always a few basics in the stock market. I was telling Kendall, you know, if you buy a new car and you stop paying for it, your car's going to get repossessed. Right? There's just basic rules of math that follow everything. Same thing here. I don't know why I use that. I've never had a car repossessed. So don't be thinking, oh, he's a financial guy talking about repossessed cars. I'm just saying that there's things that just happen based off of what happens first, second, third, fourth in the financial markets. So here's what we're after. And I want you to pay attention to these items, because this will tell you when these happens, if our stock market will start to retreat. Right now, our stock market's going up. We're hitting new highs. The NASDAQ has had a nice retracement, specifically because what I spoke about here last time on the 10-year bond, and I'll talk about it in just a second. But here's what I want you to start paying attention to over the next 3 or 4 quarters. It's called the real GDP. There's a couple types of GDP, but the real GDP, that's what it's actually called. It's not called, you know, substate. It's actually called REAL GDP. So the real GDP, that stands for gross domestic product. It's our U.S. output. How much is our economy growing? Right now, as of last quarter, we're at 4.0% GDP. Now, on average, we want our economy growing 2.5 to maybe 3.5%. In other words, that's how much our economy is growing. You want your economy to always grow, but if it grows too fast, it creates inflation. When it creates inflation, the Federal Reserve Bank raises interest rates to slow things down. When interest rates go up, people stop borrowing money. They don't borrow money, they don't spend it. They don't spend it, people get laid off, and it starts a downward cycle. So if our gross domestic product, which means we're growing too fast, and we grow fast because we're buying lots of things. If you have a good job and you're making lots of money, you spend it. We're a retail economy. Most people don't save most of their money, they just spend it. So if the GDP, gross domestic product, grows too fast, the Federal Reserve Board will raise interest rates, which will cause the banks then to raise your credit card, charge the banks then to raise or mortgage companies to raise your mortgages, charge your car loans to be higher. Everything gets raised. And so people don't buy as much. And even if you do get a loan, it's tougher to get that loan to begin with. So if the GDP right now is at 4%, if it starts to hit 5%, and you can go to this website here, bea.gov, that's a US government website, Bureau. So if you take a look at it right on the very front page, you'll see real GDP. If it starts to hit 5%, and we're at 4% right now, this is updated quarterly because it's every 3 months. If it starts to hit 5%, you will see the Fed at that point say, hey, it's growing too fast. We need to slow this down. And the reason they want to slow it down is because they know that if we don't, we'll hit hyperinflation. We hit hyperinflation, we crash really fast. So they'll do the best job they can to slow it down a little bit by saying, let's raise the interest rates a quarter of a point. So for those of you who've been around a long time, you've seen that happen before. Next, and you get that at bea.gov. So look and see us on a quarterly basis. If we start getting near 5%, understand the stock markets will start to drop. So get that, the stock markets will start to drop, which would be bad news. The 10-year bond. Now this 10-year treasury bond yield, the 10-year treasury, you can get it at Treasury Gov or get right off our website as well, here at incometrader.com. But the 10-year bond right now is at 1.63 or 1.68%. Now, back in January, I said, because it was about 1.3, I said, if this gets to 1.5, our stock market's going to crash. About 5 weeks later, it hit 1.6, and the whole NASDAQ, if those of you have been watching the NASDAQ stocks, they took a pretty good sell-off, and they sold off pretty heavily. And it all happened specifically just because of this. And here's the reason for that. Stocks on the stock market, most of them pay some type of a dividend every 3 months just for owning the stock. They say, hey, thanks for buying our stock. We're making a profit. We're just going to give you some cash every 3 months. Well, if you take a look at those stocks, the average dividend's right around 1.5%. So if you could just say, I don't have to deal with the volatility of the stock market. It's gone up, it's gone down. I have to worry about the volatility. And you're a big money manager. You can say, I can get guaranteed 1.5% a year from the US government if I just buy the 10-year bond. Now, even when you buy the 10-year bond, you're just buying a piece of paper that says that we will guarantee, the government says we will guarantee to pay you 1.5% a year every year on the money you invested with us. And after 10 years, we'll give you your money back. Meantime, you got 1.5% a year. So if we know the stock market was going up quite rapidly all through 2020 and it was overvalued, and all of a sudden you can say, I know people are going to be selling stocks pretty soon. So why don't I just sell those stocks now and buy the 10-year bond because there's no volatility. I get 1.5% guaranteed per year every year for 10 years. So people, when the 10-year bond got above 1.5%, people sold stocks, especially the NASDAQ stocks that were up so much, and down it went. So that happened a little while ago, and that's why the entire stock market started to sell, especially on the NASDAQ. Now that we've passed that, the next level here is at 2%. So if we start to get to 2%, and currently we're under 2% right now, but if we start to get to 2% on the 10-year bond, expect the stock market to once again start to sell off again. So if your real GDP gets above 5%, if the 10-year, currently it's at 4.01, it's the second revised number, 4.01, and the 10-year bond gets above 2%, if both of those happen, the stock market will start to sell off. So those are some things you can just look at, not every day, once a week, you can go back and take a look at the 10-year bond. The real GDP comes out once every 3 months. So just take a look. If both of those happen, stock market's going to sell off. So it might be time for you to take some profits and move someplace else. These are things that probably most of your money managers don't know because they're not taught to invest. I know that sounds weird, but to be a licensed money manager in North America, you pass a test about the rules that you can and cannot do with your clients. There's nothing on the test about how to manage money properly. It doesn't exist. I know because we're licensed. And to become a licensed money manager, you don't have to pass a test on how to invest. They don't ask any questions on that. It's really a bizarre situation. So S&P 500 forward earnings growth. So what do we expect? So if the S&P 500 forward year earnings, and so let's say the GDP stays under 5%. Let's say that the 10-year bond stays under 2%, but we still have some growth on the biggest 500 companies in North America. So let me show you what I'm kind of looking at with this. And so I'm going to switch screens here, and let's change screens and let's go. This one here, share, close that, log into my website here, which is just incometrader.com. And let's just type in a stock like Ford, just F. And you can see right here on the very top of the page right here, it says, here's the 10-year bond is trading right now, 1.638%. So again, when that gets to be 2%. But here's what we're talking about. When does the real GDP come out each quarter? Yeah, each quarter, every 3 months. And so it comes out at the very end of the 3 months. So where are we? And you can just go to the bea.gov website. It'll tell you the dates it's coming out. Next one. What was I looking at? Oh yeah, forward year. So I'm gonna go over here to my stock scanner page and click on the stock scanner page. I'm just kind of scroll down the page here. And there are all the different sectors of the stock market. The sector would be kind of like a state in the United States. So utility sector, these are all the stocks that trade in the utility sector, the finance sector, consumer staples sector, aerospace sector, basic material sector. So if I go down through here, I can rank these by which ones currently are supposed to be up the most this year. So the basic materials sector, ticker symbol is XLB, the basic materials sector is supposed to grow by its profits. Now, this is earnings per share growth. So this is how much are the profits expected to grow on the stocks in these sectors. So these would be like steel companies, building material type of stocks. So basic materials, these stocks are supposed to grow their profits this year by 47% over the previous year. Next year, they're supposed to, so this is for 2021, and this will be 2022. So this sector is supposed to grow by 47% this year, not the total price of the sector, but the profits. And so if you have a company that's making more profits, it's worth more money. If you have a business that's making more profits, it's worth more money. So in other words, these are the sectors that are expected to be up the most. So if I was thinking about buying, I probably wouldn't be looking at, hey, let's start looking at utility companies right now, because they're only expected to grow about 4.9% this year and only 6% next year. So I might not be thinking that's what I want, but I might be thinking, hey, look at XLB. I might be interested in something like that. But if I just kind of scroll down, auto, tires, and trucks will be up 37%, 11% next year. How about transportation, IYT? So I can take a look at some of these are expected to grow and say, maybe that's what I want to go back and invest in, something along those lines. So you can see here's the sector right now for IYT, and this is an ETF, which we'll cover here in just a moment. But look how this one has grown now for just the last 6 months. Here's where it was 6 months ago, and then here is where it is today. So it's a nice trending stock. Right now it's going to pull back just a little bit. I'll cover how that works in just a minute. It's gone up, and now it's going to pull back probably to right here around 235, which is its floor. And when it gets around 235, it's a nice time to buy this whole area. Now, this is one stock, IYT, that has about 240 different stocks in it. So think of it as a mutual fund, but it's a stock. It's not a mutual fund, but it acts like a mutual fund, but trades like a stock. And I'll tell you why that's important here in just a second. So if I was thinking about investing, this whole sector, all the stocks in this group are expected to actually grow their profits now. They're expected to grow their profits by 37% this year and 11% next year. Well, that might be something I'm interested in, because there's a stock, if you want to own something, I'd like to own things that are expected to make more money today and then even more money next year. So expected to grow their profits 37% this year over last year and 11% next year higher than this current year. So I like that. That's growth. Those are things that I actually want. So you can kind of get an idea of, if I'm looking at the stock market right now, everything looks like we're supposed to have a pretty good year so far this year, because everything is expected to do well this year over last year. Not that difficult for a lot of stocks, because last year was 2020 when the pandemic started, and some of it wasn't really pretty. So, but you can see that every single sector this year is supposed to do more this year than last year. And every single sector is supposed to do even more next year than the current year. And this is based off of every major analyst on Wall Street that follows all the different stocks. These are their combined emphasis as we kind of go through that. Will these slides be emailed? No, not on these ones here. Nice addition to the site. Thank you, Brandon. It is a nice addition to the site. I agree with that. I really like this section a lot. So now let's kind of go back to where we were just at. Change our screen again and go back here. Share. All right. So I want to know what the real GDP is, and you just go to bea.gov and go to bea.gov. Just go to the website and it'll tell you when the actual GDP report will be released. 10-year bond, I want that one to be under 2. So if this gets above 5 and this gets above 2, you will see that those numbers we just looked at for the S&P 500, you'll see those numbers actually start to decline and go negative. And actually, maybe some of those might have a negative number now, because the stock market will start to sell off as people take profits. And it's just going to hurt the stock market. If that happens, keep with some undervalued stocks and say, if I'm going to buy anything, might as well just maybe look at some undervalued stocks. So really cool ways to find some really good, simple undervalued stocks. It's not that can be that difficult for us. I'll just take a look at some defensive sectors. And by defensive sectors, I just mean there's always going to be stocks that go up when the overall market goes down. And they're not difficult. I've got a couple of them listed very simply here on the website for you, so you can kind of see them. So if I go up towards the top of the page, and if I just click over here on popular ETFs, these are right here called inverse indexes. In other words, when the stock market drops, every single one of these goes up. It works completely backwards from the stock market. So right now, the S&P 500, which is the overall marketplace for the US marketplace, the S&P 500 is in an uptrend. It's moving higher, new records, moving higher for us. So the inverse one, which is SDS, works backwards. So as the S&P 500 is going up, this one goes down. But as soon as the S&P 500 starts to actually drop in value, this one will now start to go up in value. because they work completely backwards. So you can actually go back and follow that and say, hey, when the whole stock market now starts to sell off for whatever reason, maybe it's because we raised our taxes. Maybe it's because the gross domestic product was growing too fast, or the US bond rate was paying too much. So people sold stocks and bought bonds. All those things happen. When all that happens, this will actually start to go up because this is a complete mirrored image. It's just backwards. SDS is backwards from the S&P 500. So in the S&P 500, if we go back and pull that up, when the S&P 500, this is a mirrored image backwards. When this one here starts to actually drop and head into a downtrend, then what's going to happen with SDS? It will go up. So there's always going to be sectors we can still invest in. We don't have to be afraid of where the market's going. You can't ever control it, but as long as you know what to do, there's some few basic things that make it fairly simple for us. And I know I'm just kind of covering some concepts right now, but I'll tie it together here in just a second for us. So look at defensive sectors. And then the big part here is move away from your mutual funds. Any money manager at all that has you in mutual funds right now is actually not doing you a proper service. They're using old school mentality to take additional profits from you. Now, let me explain to you what I mean by that, because it's a really large blanket statement. I don't want to say that all money managers are bad, because they're not. But if they specifically put you into mutual funds and don't put you into an ETF, there's a very specific reason for that. It's because they're getting paid extra money to leave you in those mutual funds. So let me cover that. So this is from the investor.gov website. This is the US investor.gov, US Securities and Exchange Commission. This is the SEC. These are talking about mutual fund fees. Investor transactions. So people say that, oh, you know, my money manager only charges me 1% a year to manage my money. And any good money manager worth their salt won't charge you 1%. I'll explain to you why that happens. So they say only charge me 1%. Now, if they have you in any mutual funds, then they're making extra money off you. It's how they get paid. So mutual fund fees, right off the investor.gov website, you can just go to investor.gov and type in mutual funds and fees, and this is what kind of pops up. It's a huge, huge, huge list. I kind of circumvent it down, but it's about 2 pages long. All investor transactions, such as investor purchases, exchanges, redemptions. So let's say that you're in a mutual fund. You understand that mutual funds have to charge fees? Because in the basic concept, here's what it means. Let's say that I have a $100 million mutual fund. So I've just got $100 million and people gave me $100 million cash between a whole bunch of people. And then I, as somebody who's invested in the stock market, pretty good at what I do, go out and I buy $100 million worth of stocks. And then I'm picking some good stocks and I sell some stocks every once in a while. I buy some new stocks every once in a while. Well, all those transaction fees and my time invested and all the resources I have to invest for everything, those are fees through there. But now let's say somebody else says, Mike, you're doing a great job. I want some more of this. Well, I have to go out and I have to buy some more stocks. I have to make some movements. I have to change things around. All that activity is costing somebody some money. And so who pays for all that? Well, that's why mutual funds have fees. You have investor purchases, exchanges, redemptions, fund operating costs, such as investment and advisory fees, marketing, distribution expenses, brokerage fees, custodial, transfer agencies, legal fees, accountants fees. Typically, these are paid out in part of what's called funds assets. So it's kind of wrapped up into fees that you're not actually seeing. Additional fees under the heading of annual fund operating expenses, you'll find management fees, bonuses, distributions, services, 12B1 fees. The average mutual fund total expense ratio is 3.01%. Now you can go to, I got this right down here, Morningstar.com. This first part here all comes from investor.gov, but you can go to Morningstar.com. It's the #1 website for managing mutual funds. It's free for the most part. They have some paid services, but it's a good service if you have mutual funds. I'm not a big fan of them, but it's a good service, Morningstar.com. And you can pull up and say all equity mutual funds in the United States. You can go back to 1955 when mutual funds first started, and Morningstar has the tracking data for them. You know, there has not been a single year in history since 1955 that mutual funds have ever one time as a group outperformed the S&P 500. Not once, not a single time ever in history. And if you want to, you can buy the ticker symbol SPY, Sam Paul Yellow. And SPY is the S&P 500 mutual fund. But it's not a mutual fund. It trades as an ETF. It's a stock. ETFs are newer. They've been around now for about 20 years, 23 years, where mutual funds have been around for around 70 years. And so most people are familiar with mutual funds. Now, the reason that your money manager says, I'm only going to charge you 1% to manage your money is because they're getting that other 3%. They're getting a piece of that as well. They're getting part of that other 3% on top of your 1%. So what are you really paying if someone says, I'm going to charge only 1% to manage your funds or manage your account? You're really paying 4%. So anybody who puts you in mutual funds is doing so for a reason, because they know there's a much better reason. And the much better reason is called an ETF. Now, an ETF stands for Exchange Traded Fund. An ETF is a mutual fund that trades on the stock exchange, but it doesn't change what's in it back and forth. And people like me aren't saying, hey, what's the best stocks to put in this mutual fund? Let's sell some of these stocks and buy some of these. They're set stocks. You buy the stocks, the same stocks over and over and over again. There's all those management fees and all those investor fees and all those 12B1 fees and payout fees and bonus fees. They're not there. They don't exist. The average ETF has an expense ratio of under 0.40%, 0.40%. So 3.01%, 0.40%. So any money manager that puts you in a mutual fund is really charging you their 1% fee plus 3%. So you're losing 4% right off the bat. Anybody who doesn't put you in a mutual fund might charge you 2% to manage your money. So which is the better deal now? Right. So, and I'm not saying you can't buy mutual funds. I'm not saying that whatsoever. I'm just saying, understand why somebody would put you in a mutual fund, because those fees are getting paid. And so why would the mutual funds actually want you to still buy mutual funds? Why is there still trillions of dollars in mutual funds? Because the mutual funds are giving kickbacks. They're called 12B1 fees right here off the SEC websites, 12B1 fees, which are kickbacks, payouts to the brokers to put you in those funds. So, and it's legal, not against law, and it's legal all to do. So mutual funds. So the point was, get out of the mutual funds. It's just not necessary anymore. Nowadays, we have something called an ETF, and an ETF is just a mutual fund that trades on the stock exchange. Because it trades on the stock exchange, it's optionable. They pay cash dividends. You get to keep the dividends, lower expense ratios on them. Just a huge, huge bonus. You buy them in the middle of the day, you sell them in the middle of the day. Really just no reason to buy mutual funds anymore. In fact, more money is currently going into ETFs over the last 2 years than mutual funds. So every single quarter, or ETFs have had a record quarter, and over the last 2 years, since 2019, they've actually surpassed total trading volume on ETFs versus mutual funds. So mutual funds are kind of a dying breed. It's kind of like saying, hey, I still have that old telephone in the kitchen on the wall with that 25-foot extension cord versus your cell phone. You know, at some point, when does it become irrelevant? All right, Mike, how would you see the extra 3% you're paying if they advertise only 1% fee? The extra 3%, you don't. You don't see it at all. It's just, you're just being charged because it's coming out of your profits. And so your profits are lower, where the ETF will be at a higher profit versus the mutual fund. Remember that there's never been a single year ever in history, go to Morningstar.com, that mutual funds have one time ever outperformed the S&P 500. So why wouldn't you then, if that's the case, just go back and buy this ticker symbol right here? Ticker symbol is SPY. Here's the ticker symbol. Wait for it to pop up on us. There we go. Why don't you just buy this ticker symbol, SPY? And when you buy that ticker symbol, you now own the top 500 largest companies in North America. You have all the different sectors. You have the housing sector, the retail sector, transportation sector, the energy sector, the basic materials sector, consumer sector. You have all the sectors of the stock market, biggest 500 companies in North America in one stock. So ticker symbol is SPY. This is the S&P 500. And there's never been a single year since mutual funds have come out that they have actually outperformed this. Now, specific mutual funds, yes, but never mutual funds as a group. So which mutual funds are you in? Why do you want to even take the chance? Why don't you just buy this? Not only if you buy this, this pays a dividend of about 1.6% a year on top of that. And you get to keep that dividend. Where most mutual funds that pay a dividend, unless they're classified as a dividend fund, if they don't have that word in the fund, dividend fund, the mutual fund probably still pays a dividend, but the dividend goes back to the mutual fund company as bonuses and kickbacks. But you still pay the taxes on them because those stocks in that mutual fund are under your name. They don't tell you that either. And I'm not trying to be harsh on anybody out there in this business, because everything has good and bad about it. But as long as we're educated, we can make better decisions. It's just that nobody ever tells you what you should and shouldn't do, and then lets you make up your own decisions. And I'm not saying that you shouldn't own a mutual fund, because at least putting money into some type of an investment long-term, even if it's a mutual fund, is better than putting it into a savings account at 1/8 of 1% a year. But everything gets better as you learn up. You know, if I want to move bricks from point A to point B, you know, I can put them in my hands. I can carry bricks one at a time. But if someone gave me a little red wagon, I'd use the little red wagon. But then if somebody gave me a pickup truck, I'd use the pickup truck. But then if somebody gave me a great big huge front loader, front loader machine, I'd use the front loader, because everything gets substantially better. So why would I use mutual funds if you have ETFs now? And by the way, there's no commissions on the ETFs. They're free because they trade like stocks. Huh, pretty cool. So why would I use a mutual fund? Because that's what you're told to do. Why are you told to do that? Because somebody else is making money off of you. That's the reason why. And it's not against the law. It's just that, let's be educated. If I don't mind paying somebody that because they're actually doing a really good job, better than the marketplace, that's fine. But majority have never outperformed the stock market ever one time in history. So why do I want to go that route if I don't have to? All right, so let's break this down now and start to tie this together and see what does this mean for us as investors, because it's not just about, what's there. So what do I want to go back and do? So let's see what we're after here. So first, I want to say, is it possible to actually, as an individual investor, do a good job making money and really outperforming the stock market with maybe only working 20 hours a year? Yeah, in fact, that might be a lot of hours. You might be able to do it in 15 or 10 hours a year based on where you're at. What about targeted funds? Targeted funds, if they're still mutual funds, I'm still going to pass on them because they still have all those fees. It's like saying somebody punches you in the face. Well, what if that person punches you in the face isn't a professional boxer, but they still have a hammer in their hand? You're still getting punched in the face, Should you diversify your funds between SPY, QQQ, and IWM? Really good question, Ralph. So SPY would be the S&P 500, the Qs would be the NASDAQ, and IWM would be the small cap stocks. That would be one way to do it. So I'm going to show you probably, I think, what's a better way. And this is kind of what, if you really wanted to if you wanted to become a professional money manager, what I'm about to show you is what you would learn from your company that you go to work for. SEC won't teach it to you. Even your company doesn't really teach it for you. The company just gives you a breakdown. But here's what you have to do. And so I'm going to show you how easy it is to become your own money manager, manage your own account, and outperform the stock market year over year. But you know what you have, you know what's to look forward to. And I'm going to do the whole thing here in, what time is it now? It is, no, wait, I'm going to do the whole thing in less than 30 minutes from beginning to end. And you do this once a year for 30 minutes and you're done. And you do it again next year and again next year. It's called rebalancing. So once a year, you go back and you rebalance, unless there's something that needs to be changed. We just do it once a year. So let's go through it. We're going to try to buy, and we're going to go look at some ETFs, exchange traded funds. And we're going to buy them in lots of 100. And we're going to do it in lots of 100 for two different reasons. One is because it's optionable. And if it's optionable, it means I can make extra money every single month by doing something called a cover call. So I'm doing lots of 100. And two, at some point, you'll probably get better at this. And if you ever want to be able to fix a bad trade, which people don't talk about, and it's one of the reasons we're who we are, we specialize in teaching people how to fix bad trades. It's the reason that we have created every single course that CNBC television has ever taught worldwide. My company has done every one of those courses. It's the reason that every single course that Business Week magazine has ever taught worldwide in the financial markets place came from my company. We are the only company that's ever been on the Chicago Mercantile Exchange, which is the largest exchange in the world, teaching the floor traders to trade while the exchange was open, my company. And one of the reasons for that is because we're good at what we do. One of the reasons we're good at what we do is because we specialize in how do you fix a bad trade. And most people just say, hey, if it's bad trade, just sell it. Put in a stop loss, sell it for a loss, which is better than doing nothing at all. But it's like saying, hey, I'm about to get into a car crash, so I'm going to put my seatbelt on before I crash my car. I won't probably die, but I'm still going to get hurt, right? I don't want to get hurt. So are there ways that you can stop that? Yeah, your car actually comes with brakes and it comes with a steering wheel, So do you want to crash your car and get a little bit hurt, but you're using the seatbelts and airbags, or do you want to actually use the brakes and the steering wheel? Well, at some point you're going to say, I want to use the brakes and the steering wheel. You can do the same thing in the stock market, and we teach that. Obviously not in this class, but if you buy in lots of 100, you actually have the ability then to go back and fix some of your bad trades. And so that's something you just put in the back of your mind, just knowing that you can fix bad trades, but most people don't teach you that because most people don't actually trade for a living. All right, we're going to take a look at some stocks, and we're going to go looking for some ETFs, and we're going to put them on our watch list, and we're going to use those to maybe write cover calls every so often. So here's what we're after. We're going to go back to the website now. And this is I'm going to go through the entire process step by step. This is how quick and easy it is. And you're going to do this once per year, just once. You can do it more if you want, because you say, I am just bored. I got nothing else to do. That's great. If that's what you want to do, that's fine too. But here's the basic part of this, really, what we're after. So I'm going to go over to section on our website here. And our website is called incometrader.com. I'm going to go to the website. And I'm going to click on the link across top here. It says asset allocation. Now, this is kind of what your brokerage firm will do for you, but they'll use their company's breakdown on this, but it's same process. So portfolio diversification, here's what we're going to do. And I'm just going to ask some questions. Now, these are the same questions your brokerage firm asks. And this first one here is, how old are you? Let's just say you're 45. I'm just trying to go through what I think maybe the average age of somebody on our class tonight might be. At what age do you want to retire? example, 65. By the way, you can't say backwards. You can't say 44. It won't work out. So let's just say 65. And you can change these as it goes through to see what's after. Now, question 3, would you like to be an aggressive or conservative portfolio? Well, typically when you get above 55 years old, you start going a little bit more conservative. Before that, you can go a little bit more aggressive. Now, aggressive means that you're going to have some bigger gains in the up markets, but you're also going to have some bigger losses in the down markets. And if you're younger, you have time for that. Oh, we just had a bad market, well, then for the next 20 years, we had a great up market. And so it offset that. But if you're older, you might not have time for that. So if you're 45 or so, you can say, I'm going to be a little more aggressive. What's the current value of your portfolio? And you can kind of just say, maybe between my 401k, IRA, or whatever, I got 50,000, 100,000, 150, 200, $500,000. My parents left me $1 million inheritance. I don't know. Let's just put in 200,000, and we can change this because I'm just using this as an example. It's all I'm doing here, guys. I'm not saying that you have this and you have more or less. I'm just as an example. Then it says, do you want to add any additional funds to your portfolio? And you say, at the moment, no. Let's see. And then it comes through as a breakdown. And now we're going to go back and use historical numbers from the S&P 500 since the first day that we've got data here, which goes back decades and decades and decades. And on average, based off what we have here, you're going to have some money that we go through here that's going to be into stocks, which are just equities. So you hear the word equities, that means stocks. Then you should also have some of your money into international equities. Some money's into bonds. Some money's into incomes, which means ones that pay dividends, REITs, which are real estate investment trusts, and cash. Now, based off of your age and how old you are, this breakdown changes. The younger you are, the more of your money, 44%, will go into stocks. The older you are, less of your money goes into stocks, and you start moving more into some cash, into some REITs, some incomes, and some bonds. And so the numbers start actually going backwards as you get older because you wanted that money to be a little more conservative. So this just tells you now, as you go through the breakdown, it says 44% of your current portfolio should be in, or about 88,000, should be in equities or stocks, or stock ETFs, as we kind of go down through the list here. Can we teach you how to be a day trader using either stocks or options? Nope. We could. We don't do it though. We can teach you how to read charts, when to buy, when to sell, but we don't have a specific class on day trading because most people that day trade lose their money. And so we're just not teaching that. I've taken a trading course with Christine. Thank you, Al. She's a great instructor. She's actually a fabulous instructor. Which course teaches repairing spread trades? And that's the advanced options one, is the repairing spread trades. So as we kind of scroll down through here, this just tells you that by the time you're 45, 46, 47, 48, as the time goes down, here's how much your portfolio should be worth as you get older each year. And now by the time you finally get to be 65 years old, your portfolio should be worth about $651,000. So by the time you're ready to retire, your $200,000 should be $651,000. Say, well, that's not too bad. Is that going to be enough money to retire on? And you say, no. That could be one, heart attack, and now you're in the hospital and you got no money left. So you say, well, what if I wanted to go back now and maybe put in, an extra $100 per month? Where will I get to now? Will that get me to where I want to be? If I had $100 per month, and now you say, if I retire, I'm going to have around $697,000. Would that be enough? So now you kind of play around with this and see what you kind of need to do to get to your goal. But here's what I want you guys to understand. This right here, $697,000 I talked about here, this is what money you'll make if you do what I'm about to do yourself. If you have somebody else do it, let's say this person says, I'm only going to charge you that typical 1% management fee. Now, that same $697,000 that you would have made if you did it yourself is only $539,000. This is what somebody's going to charge you to do this for you. They're going to charge you $150,000 to do what I'm about to do in a half an hour. And you're going to do it once a year for the next 20 years. 20 hours. Once a year for 20 years, do it for an hour, and you're done. Just rebalance once a year. Once a year, come back and just do it again. And do it again once a year. And they're going to charge you $150,000 for 20 hours. What's that? What's that come out to rate per hour? And you understand why people want you to give your money to somebody else? Because what do you think they get to do the entire time they have all your cash? If you give all your money to a money manager, all your money to a bank, what do you think the bank's doing with your money for those 20 years that they have your money? You might say, yeah, it's in your account, but the money is in their account. They just electronically say it's in your account. So what do you think they're doing with your money for 20 years? Yeah, they're reinvesting it, making all kinds of money. That's why you're not taught to do this yourself. It's the only reason you're not taught to do this by yourself. It's not that they're that important. So let's go back now. Let's just go back and keep it simple. Just say I'm not adding any extra money. Calculate my breakdown. All right. So I should have about $44,000 into equity ETFs. These are just stocks. Now, if I want, I can go back and let me just kind of write these numbers down. Get my pen. Okay, $44,000. Equities, international equities, $42,000, 21% of my portfolio into international equities. Write that down. Bonds. So now I'm just going to take these numbers here, write them down. Okay, now if I want to go back now and look at what are all the really good equity ETFs out there? In other words, stock mutual funds. And equity just means stock. That's all equities mean, stocks. An ETF is just what I want you to trade versus mutual funds because they're just a better deal. You know, you can go to gas over here on this corner. Gas is $2.88 a gallon. On the other corner, it's $4.25 a gallon. Same gas. Why would you pay $4.25 if it's $2.88 on the other side? I just wouldn't pay it. It's just not necessary anymore, especially if it's on the same corner, just the opposite side. So now I can click here to go pull them up. Click here to see a complete list. Click here to see a complete list of all those ETFs. I'm going to click on it. Now, all I'm going to do now, as I just said, I'm supposed to have $44,000 in equity ETFs. $44,000. Jennifer Jones says, do you have people I can pay to do this? Yes, we do. I'm one of those people you've tried to Greek to me. It's too much what your company charges me. We charge a flat 2%. You can contact us afterwards, but try it here with us first and see if you get this. If you really don't get it, go ahead and contact us. I would rather just teach this to you first. At least then, even if you had somebody else manage your money, at least then you'd know whoever it was, you'd know what they were doing, How you transfer your 401k, do it yourself to avoid the fees. A very simple process, Amanda. Just go ahead and contact our office after this is over, and we'll give you a sheet of paper step-by-step how to transfer your 401k over and do it yourself. It depends on if you're still working for the company or not that started your 401k. You can still do it, but there's different processes for it. So now I'm just going to scroll down the right-hand side here. I'm going to scroll down the right-hand side until I find a ticker symbol that I like. And I'm literally looking, this is a 3-month chart. This is 3 months ago here. Here's where it is here. I'm just going to go down until I see something that's not really heading in a downtrend. Like, do I want this one here where it was here 3 months ago and it's lower now? I don't want that one, right? So I'm just looking at the right-hand side over here until I find something that I like. XLP. So here's XLP. So let's click on XLP, the ticker symbol. Now, by the way, this one, if I buy this ticker symbol, XLP, it actually pays me 2.4% a year dividends. So if I just buy this, it doesn't move a single penny all year. I'm going to receive 2.41% of the purchase price in cash every year just because I own it. That's called a cash dividend. There's nothing to do other than buy this stock and you get paid. So now, let's say that I like this one here. It's starting to move higher. We come down. We just started making some lower lows, so it's a little bit cheaper. And we just started to break out to the upside. If you've never known how to read a chart, I can show you that part later. But all I'm after here is this one is just now starting to move higher again. Broke through a little ceiling right in through here. Broke through a little ceiling right here, went up, pulled back, and now we're bouncing again. I said, okay, I like that. So I'm supposed to put about $88,000 into consumer staples. So I could buy this, and this is the consumer staples sector. Okay, so that would be around 1,300 shares of the stock. So then I'd go, I could say, I'll buy this one here, or I might go back and say, what if I also wanted to buy maybe some stock of, a really good quality undervalued stock instead. So if I hit my stock scanner and said, show me every really good, fundamentally sound quality stock that's undervalued, which means it's on sale. Look at that, Intel. Intel is moving higher. I like that. Computer technology. How's that 3-month chart look? There's a nice stock moving higher. It's really worth, Warren Buffett says, his discount cash flow says this stock's worth around $70 a share. And currently you can buy it for $63. It's undervalued. Not only is it undervalued stock, it's a really good quality stock as well. Good quality stock. So I know that's part you don't understand just yet, but in other words, I'm going to buy a good quality, fundamentally sound stock at a discounted price. In real estate terms, that's the same thing as saying, I'm going to buy a house that's a really good quality house at a short sale price. Same process here. So maybe I buy some shares of this, maybe I buy 500 shares of this stock, Intel, and maybe 500 shares of XLP. And now between that, I've now come up with my $88,000 invested, and I have one good quality undervalued stock, and then I have a stock that covers a whole sector that has about 35 different stocks in it. So between those two items, I have about 36 different stocks, but just in 2 ticker symbols. And I'm done with that portion of it. So then, and let's go back now to screen share. Let's go here, share. So let's say that we're going to buy 500 shares of, what's that, XLP that we wrote down? XLP and INTC. And then that covers our item. And we're done with that for the whole year. Remember, this is the same thing your brokerage firm does, because they're trying to diversify your portfolio and put you in some stocks, some international stocks, some low risk bonds, some dividend paying stocks, some cash, things like that. This is the same thing. So we're just diversifying. The first part of it's now done. Then we go back and say we wanted to have $42,000 into international, $42,000 into international equity ETFs. So stock scanner, go down to where it says international equity ETFs. And again, I don't want to buy a mutual fund. And it tells me to buy a mutual fund. It's trying to take extra money from me. I want you to be able to do this yourself. It's not that difficult to learn. You know, for people like Jennifer, you said that you just don't want to do it. I get that. And you can't make somebody do it. So, but at least even if you have somebody else manage your money, I still want you guys to know what's happening in your account, what people are doing, because nobody cares about your money as much as you do, aside from maybe your kids, but it's your money. And I don't want people to take advantage of you just because they can. So international equity ETFs. So now I go back and look at this one. I'll say, well, which of these are in an uptrend? And we kind of go back and look at them. See if I see right here. I like this one here, EWG. This would be the Germany. These are all of the major stocks in Germany right now. So I'm going to have some international exposure, not just the U.S. market. So I want some money outside the U.S. And I'm supposed to have about $42,000 over here. So this is trading about $33 a share. And there are about 175 stocks in this ETF here. You don't have to know that, but just think of it as a mutual fund. It's all the biggest German stocks in one item. So I can buy EWJ. So I click on EWJ, take a look at my chart. It's a good looking chart. So here's the stock over the last 6 months. Got a nice uptrend. Here's when COVID kind of kicked in with everybody. And since then, it's just moving higher, 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 higher. So I can go back in there and buy about 1,200 shares of this stock. So then we go back to our list and say, hey, I like this one. And again, by buying just this one ticker symbol, you're diversified because you have about 175 big stocks. So we go back and say, buy 1,200 shares of, what was that one? EWJ, is that what I wrote down? EWG for Germany. Then we go down to the next one. If I'm going too fast, go ahead and ask some questions. How do we gain access to your stock paper? I'll show you how to do that, David. It's actually very simple. It's proprietary. We have a lot of really cool proprietary tools on here. A lot of people say, well, just go use, what am I thinking? The big one here, Yahoo Finance. Yahoo Finance doesn't have these searches and scans I'm showing you right here, or a good stock and find the best quality low stock. You know, you can look at a stock and do research on a stock, but you can't find what you're really after on Yahoo. What about the potential that consumer stocks decline due to tax increases? Wouldn't this impact XLP? It could, and that's what I'm going to show you here just as well here, Dwayne, because remember what I said, there's going to be some things that tell you the overall stock market's going to drop. That hasn't happened yet. And until it happens, you want to sit back and say, you know what, eventually at some point, house prices are going to drop in Florida where I live. Okay, when? So I think I'm just never going to buy a house. You know, and then in the meantime, your house, the house you wanted to buy has gone up 800%. You say, but at some point it's going to drop. Well, until it does start to drop, I should still do what? If I want to go north on a freeway, get on a freeway that's already going where? North. But as soon as the freeway stops going north, for whatever reason, I don't know when that's going to happen for sure. It'll start to happen when either the current presidential administration raises corporate and personal income taxes. We start to see the GDP raise over 5%. And the 10-year bond get over 2%. When all of those start to happen, at that point, yes, the stock market will start to drop and consumer products will start to drop at that point. So what do we do then? Now we go into the defensive sector stocks like utilities, which are the ones that if we looked at the stock scanner page, were expected to be up the least this year and next year, the utility stocks. Those will go up the most as soon as the stock market starts to drop. Okay, so now, then we go back and we just say, okay, if we got that one, then we do the same thing now with bonds. go back to our stock scanner page, ETF scanner, bond ETFs, and just go back to the whole process here, kind of one by one, and say, what about PFF? Now this one here, if you buy this ticker symbol is just PFF. This is preferred US stocks that pay high dividend. That's bonds, but they pay 4.83% a year. So even if it's move a penny, you'll make almost 5% a year from just holding this. And it's going to be a fairly predictable pattern for you. So overall trend for the last 6 months, here's where it was 6 months ago. Right here's where it was 6 months ago. And here's where it is today. Overall trend's looking higher. So if I buy this one, I'm supposed to have about $14,000 here. So it's trading around $38 a share. Maybe I buy 300 or 400 shares. And use this once a year. So you go back down and you say, okay, well, what else was I supposed to do? I wanted to buy some REITs. And you pull up all your REITs. I wanted to just go, and all you're after is just which chart looks the best to you. That's all that you're after. Real estate sector spider fund pays 3% a year average dividend, and it's in an uptrend. I mean, do you really care which one you buy? When your broker says, hey, I got a great mutual fund for you, do you really care which one they put you in? As long as it's diversified and it goes up. Those are the two things you're concerned about, right? Well, they're all diversified by default, and you're going to look at the chart. So one of the things you will want to actually learn is how to read a chart. You'll get better that time goes on, but just say, what's the overall trend? Is it going up or is it going down? So now you go through all of those. And then when you're all done with all of that, you're all done with it, you're now going to come back over here to the left-hand side and go over here where it says watch list on the left-hand side of the page. And you guys can all see my screen, yes? Yep. So we're going to go to watch list, and we're just going to type in your ticker symbols here. So let's type in that we're going to have the ticker symbol XLP. So we go through this one here. XLP, add it. And then maybe we also, because we're buying that one, we're also buying EWJ or EWG, and add that one. And PFF, and add that one. And you just kind of go down the list of whatever else you might have bought. And now you're going to go back and say for EWG, we can click on notes. And under my notes section, here's just a quick little chart of your EWG stock. Under notes, we're just going to put down here that we bought 1,200 shares. March 23rd. And then save. And then we'll do over here to where it says PFF under notes. And we're almost done here, so kind of stick with me here. So for PFF, we're going to say that we bought 400 shares. March 23rd, save. And XLP, notes. Okay, and then you put your Intel if you bought Intel stock on here, things like that too. There's some reasons you want to buy some other things on here. But now when you're all done with this, we can now go back, and every day when the markets are closed, you can come back and you can just go ahead and click on whatever we have going over here. So we can click this right here. And on one page, you can take a look at your entire portfolio and say, okay, how's that look? It's still kind of in an uptrend. Yep. Kind of maybe sideways. Yep. Kind of in an uptrend. Yep. And you can look what you're after here, XLP, just starting to kind of move higher. And on one page, you can take a look at your entire portfolio really quickly and see if anything looks out of whack, or say, does anything look wrong with it, or should I make some changes? But you can look at it really quickly. And one of the nice things about this, so Jan says, in buying ETFs, should they be trading over 1 million shares a day? They don't have to. With the ETF side, it doesn't hurt if they do that, but they don't have to. Looks like ETFs are high. I'm all about buy low and sell high. What are you missing? What's low? Okay, so let's pull up, and we'll come back to this page here in just a second. So Teresa, question was, it looks like all the ETFs are high. I'm all about buy low, sell high. What am I missing? Okay, how low is this one? Should you buy that one now? Because it's pretty low. What about next month if it's down here at 10? Then it's even lower. Should you buy then? Next month is at 9. Should you buy then? Next month is at 8. Should you buy then? Next month is at 7. Should you buy then? Question is buy low, sell high. Yeah, but what's low, what's high? That's the real question. What's low, what's high? So if I go back now to, and here's just, let's pull up here and Intel and say right here, is it high right now? Is Intel high right now? I don't know. What's low, what's high? It's a relative number, correct? I bet people were looking at this, and let's pull up maybe a 1 year chart here, 2 year, 3 year. I know what we'll do. We'll pull up SPY, and then we'll pull up a longer term chart. come up for us? Okay. I bet people were looking at this when it was right here and thinking, man, there's no way I'd buy this right now at 350. This thing is high. It's at all-time high. I'd never buy right now at 350. It's way too high right there. And all of a sudden it went up here to right here to 375. People said, man, I wouldn't buy it now at 375. It's way too high. But you know what? I wish I would have bought it when it was low back here at 350, but I wouldn't buy it now at 375 because it's way too high. Now it's at 390. Man, I wouldn't buy it now at 390 because it's way too high. I wish I would have bought it when it was low back here at 375, right? What's low, what's high? It's a relative term. So you think low means the chart's in a downtrend. Low just means that it was cheaper before it is today. So is it high? I don't know. If I ask you, is the price of your house higher now than it was 10 years ago? And 10 years ago, was it higher then when it was 10 years before that? Well, if that's the case, nobody would ever in their right mind ever make an offer and buy your house. They would be crazy because they're buying your house high, correct? They're buying your house high. So why would you ever buy it? I wouldn't buy it. Your house is way too high. It's the highest price now it's ever been ever in history. But I bet 5 years from now, it'll be higher now than it is today. And then I'm thinking 5 years from now, man, I wish I would have bought it 5 years ago when it was low, right? What's low, what's high? It's a relative term. So when you hear that term buy low, sell high, it's taught that way to keep you confused because they don't tell you what low and high is. You're just taught buy low, sell high, but what's low, what's high? Unless you're taught what low and high is, it's a relative term. How do you make money? Buy low, sell high. And what else? And you're in it for the long haul. Garbage in equals garbage out. I'm not trying to pick on you, Teresa, because everybody has that same thought process. I did when I first got hired. It's just because nobody tells you what low and high is. We assume that if something's in high today, that it's high. No. What if it's still over? What if I built my house? It's $1 million home, and I built it and I sold it for $2. Someone bought it $2 and said 2 hours later they sold it to somebody else for $4. And somebody said, man, I'm not paying you $4. That's the highest that house has ever been ever in history. You only bought it for $2. You had a 200% return on your money. I mean, it's crazy where you're getting that money. Then you say, well, I'm gonna do it anyway. It's only $4. So you buy it $4 and you turn around and sell it to somebody else in 10 minutes for $10. And somebody says, are you crazy? I wouldn't buy your house for $10. Look at that chart. It's gone from 2 to 4 to 10 in just a matter of seconds. I'm not paying you $10. That's way too high. No, high and low are relative terms. What makes it important to me is it overvalued? That's a whole different story, but nobody teaches you that because they don't want you to understand the stock market. You don't understand the stock market, you give your money to somebody else. You give your money to somebody else, they make money off you for the rest of your life. So low and high, relative terms. So I'm okay with low and high. I don't care if something's high. It doesn't make any money today. Less than today. Well, less than today. Well, 2 months from now, you'll be saying less than today. And that would have been 2 months ago. You said, man, I wish I bought 2 months ago when it was less than today. It doesn't work that way. Been trying to get to invest a self-directed IRA and solo 401k. She uses someone managing her funds. She works at a bank, and she said she only pays 1% and not more. She says because it's through her job, she's getting a discount. What do you think? I think Sarah has been brainwashed. Anybody who tells you they're only getting 1% management fees, ask them if they have any annuities. Ask them if they have any mutual funds. Ask them if they have any insurance products. If that person who's managing your funds makes any kind of a commission on anything else, guys, understand you're not getting 1%. Anybody who tells you you are, you're not getting 1%. This is what I do for a living. I'm very good at what I do for a living. And I'm not trying to tell you that you can't have a 1% account, but I'm saying if you are, the chances are that you're not actually paying 1%. They're in other services and products that the bank is getting their fees on. You've heard the term, there's no free lunch. Somebody's always making some money off of it. That's what I'm trying to say here. So even if you say, but they only charge you 1%. Yes, but the other things in your account are making up for more than that 1%. They're making up 2, 3, 4 more percent on top of the 1%. So now you're paying 4 or 5% total, but you don't know that because they won't tell you that. All you have to do, guys, is go back and look at the SEC website that I just gave you, investor.gov. It'll explain that in detail. I'm not making this stuff up. I don't. So, all right. So Sarah, that's a good question though. So how do you do your red arrows playing the review? So good question, Teresa. So now we go back to go back up through here and now go into your watch list. Now, at the end of each day, you can kind of go back and look at these here, or you can say, pull them up on the chart. So now on one page, you get every one of your stocks on one page at the end of each day. Every day you get one of your entire portfolio comes up and just kind of scroll down. As long as you're not seeing anything, it's making lower highs and lower lows, which just means there's a low, and then it pulled back and dropped lower, pulled back and dropped lower, pulled back and dropped lower. So all we're really after here is this. As long as what I look at isn't in a serious downtrend, like we were looking before, SDS, for the most part, you're going to keep what you have. Now, this is a serious downtrend here on SDS. There's no ifs, ands, or buts. This is a serious downtrend. But it's because the S&P 500 is in a nice uptrend, and this is the inverse of the S&P 500. So here's what you're going to get. In that watch list, at the end of each day when the markets are closed, if your stock that you had that are in your watch list, any of those stocks in your watch list at the end of each day, if any of those have come down now and broken this red line is the floor. It's supposed to pull back to the floor. Don't be concerned if your stock pulls back. Nothing goes straight up. It goes up and it pulls back, and it goes up and it pulls back, and it goes up and it pulls back, and it goes up and it pulls back. All stocks pull back. Don't be afraid of that. But if it starts making lower lows, which means that these red lines are getting lower, the floor is getting lower, you should be concerned. So anytime that any of your stocks now come down and drop beneath that red line, you will get an email from us, and it'll say your stock EWG in your portfolio broke through its support level today. Click here to look at the chart. You'll actually get an email from us and a text, both. Now you can turn the text off if you don't want the text, but you'll get an email and text. Click on the text, takes you right to the web page, and you can actually look at the actual chart and say, whoa, maybe it just broke support. I want to go back and sell it. So now you just go back to your brokerage account and you say, I want to sell it. Really simple. Just go back to your brokerage account, sell it. You know, your broker can help you with that. If you're brand new, we can teach you how to buy and sell stocks. It's a really simple process. But this is what you do. Now, once a year, you just leave these stocks in there once a year and let them grow and grow and grow until they start to drop. Same thing your broker is doing right now with your mutual funds in your account. They're just holding on to them. And you say, what should I do? It's dropping. Don't worry about it. You're in it for the long haul. No, I'm not. I'm in it for a profit. So what we'll do instead is we'll tell you when your stock's starting to go into a downtrend, when it's no longer in an uptrend, when you may no longer want to own it anymore. We'll just send you that email and that text out there because that stock is in your watch list. So you might not get a text for 4 months until finally one of those stocks finally starts to break down and head lower on you. And you start making lower lows and things start to sell off. I can't wait to show you what he said. Thank you, Sarah. She'll say she works at the bank, so she knows better. And you can say, that's great, but I just talked to the man who created every single stock market course that CNBC television has ever taught worldwide. I spoke to the only man whose company has ever been on the largest trading floor exchange in the world while the market was open. We're the only company ever in history that's ever done that. And so what I'm saying is I have a little bit of clarity on how the markets actually work versus somebody who just went to work at a bank or somebody and they passed a test. And so, and I'm not trying to downplay anybody because people have all kinds of different jobs. I just want, my really whole goal is I've seen so many people be taken advantage of when it comes to the stock market because they don't know what's happening. And they listen to somebody say, oh yeah, I'm a stock market person. And you know, the gross domestic product is going to be up X amount this year. So you really should be really careful about the equities you want to invest in. And so all kinds of things should happen. So give me your money instead and I'll make sure we do it for you. It's garbage. It is garbage. And so I just don't want you to fall for that because I've seen too many good people with money turn around and give their money to somebody else who doesn't care about that money and won't turn around and sell that or protect it or learn how to go back and change it. Last year, our managed money account, our average account was up over 33% last year. S&P was up 18%. We almost doubled the S&P 500. Yeah, the overall market was up 18%. Most mutual funds, the majority of mutual funds did not even make 18%. Our average account was up over 33%. We're pretty good at what we do. That's what I'm trying to get through here. And I'm not saying give me your money. I want you to learn this because it's not that difficult. So I'm trying to go back to. Obviously, we did some more things to the accounts to make some extra money, but it's just not that difficult to go back and make that money. Is what I'm after. So let's kind of get to it, kind of wrap it up and see kind of where we're at here. Let's go back now to here because our time's running up here. I'm sure Kendall wants to get back with his family. Anyway, guys, that was your training through here. Let me recap it. Obviously, we have a class coming up. I'll cover that with you, but let me just recap what I covered with you here. Are we good with that? So number one, stimulus checks are good for the economy, but it creates a false sense of cash, which sends the economy up, which means that the only way to pay for that now is to raise taxes on both corporates and individuals and then print up more money. This, by the way, will start at some point to make the economy drop. And then at that point, you're gonna have to go into defensive stocks like consumer cyclicals or some of the inverse ETFs that go backwards and some bonds. Next part here, watch the real GDP, go to bea.gov When it gets around 5%, understand when it gets around 5%, doesn't mean the stock market has to crash, but what's going to happen is that large corporate investors, hedge funds, pension funds, insurance companies, mutual funds, and investment banks will start to sell stocks to lock in their profits. And when that happens, because the inflation part that comes here, when that happens, the stock market will start to drop. When the stock market drops, companies make less profits because companies bank off of the price of their stocks. Companies make less profits, which means they don't have as much money, which means they won't hire as many employees, which means that those employees won't work, which means that employees that do work won't spend as much money because they're afraid about it. Anyway, it starts a downward cycle. So GDP gets above 5%, 10-year bond gets above 2%. At that point, start to watch the stock market. It will start to pull back. Just like the NASDAQ had a heavy sell-off as soon as the 10-year bond here hit 1.5% just about a month and a half ago. Keep a look at the S&P 500 current year's growth. That's on our website through here, but look at the forward year's earnings growth and just say, are we expected to grow more this year than last year and more next year than this year? As long as we are, that's really good news. Stick with or move away from mutual funds and into ETFs. So move out of those mutual funds, guys. They're just not a good investment anymore. There's just better investments out there. I'm not saying you can't have a mutual fund, but there are just better ones out there. Yes, that was a proprietary floor indicator. Debbie, are the red and green lines and arrows automatically generated by my website? Yes, they are. There's a lot of really cool proprietary features on the website. I obviously didn't have time to cover that. It wasn't my real goal. My real goal was to give you some basic education on things that you could look for as an investor. So if you heard the news, you say, hey, the 10-year government, you can hit a 10-year bond or 10-year note. And they'll say it's at 1.7. Ooh, I know what that means. That's getting close to 2. That's what I'm trying to get to here. So just some basic things that you can keep in mind through here. Cool. How do you set up the alerts? Ralph, all you have to do is just type them in the portfolio. It's done automatically. What's preferred time frame? What's the cost of the program? It's $200. Coval indicator. Yep. Some more proprietary things on there. So let's kind of go back through that. Obviously, we have a class coming up here. It's April 10th and 11th. It's a 2-day class. It's online class. If you want to learn some of those proprietary tools, like how do I read charts? What is an uptrend? What's a downtrend? How do I know a stock is making lower lows? When do I enter into a trade? How do I actually write some covered calls on those stocks? Once I buy some of those ETFs, how do I get extra money to write covered calls on them and collect a dividend so I can actually turbocharge my rates of returns? So we have a 2-day class, April 10th and 11th, 11 a.m. to 6 p.m. It's online. You can do it anywhere in the country as long as you have an internet connection. So that has 2 days website. Give you a cash flow video to kind of get you started a little bit on writing covered calls, and our website access 2 months on top of that, which is really just $25 a month for the website for $197. So 2 days. Can't go wrong. If at the end of the very first day you say, Mike, it was the worst class I've ever had, I'll give you $200 back. I'm not doing this for your $200. I really want to teach you how to do this. Obviously, I want you on our website using it, learning how to do this, teaching your family, your friends, things like that. But I want you to sign up for it. It's protectwealth.com/stocks. That's the website. You can sign up for it. It's $200. It'll immediately get you access to the website as of today. You can actually log on tonight. You can type in some ticker symbols, take a look at them, and then I'll set you up and make sure somebody gives you a phone call and get you started and say, here's going to be your access. Here's where you log onto the website to get to the actual live class. It'll be in person with us. We'll be live, just kind of we are through here, and answering questions. It's an interactive class. So we'll answer all questions all throughout the class. And it's 2 full days, Saturday and Sunday. And oh, by the way, bring a guest with you as well, because your guest gets free access as well. So they'll get a username and password. And so if you've got a spouse or somebody else in your family you want to bring with you and get them on the class, do it. Get them on there. So I want them to learn, because you actually learn better if you're with somebody else. If it's all by yourself, you'll still learn. I learn by myself. But if you can teach this and help somebody else learn this at the same time, you'll pick up more and you'll learn more. So go to protectwealth.com/stocks. Register for the class. Just a flat $197. Get immediate access to it. We'll have somebody contact you tomorrow and say welcome. And the next couple of days, I'll give you your link for the actual class coming up on the 10th and 11th. These are Eastern times, and they'll be from 11 a.m. till 6 p.m. Eastern time. So hopefully everybody has a chance to, it's not too early in the morning for people on the West Coast and too late. So I think that's all I got here. After the 2 months, yes, the Income Trader website is just $25 a month. It includes everything on it. There's nothing hidden. There's no hidden charges for this, hidden charges for that. Nope, there's no advertising on the website. The website was built by me, for me. I built it up as an investor would actually want a website to be, to research and find really good quality stocks that you just can't find someplace else. I can go to the websites and I can pull up a particular stock, but I can't do those things I can do on this website here that I have right through now. So it's really a really cool website. We'll teach you how to use it. More specifically, I'll teach you how to write covered calls on your stock, make some extra money, how to read a chart, when to enter, when to exit, how to open up your brokerage account, how to transfer that money. If you need some specific help on your 401ks, we'll cover that in class. If you need help before that, I'll teach you how to do all that kind of stuff. It's not that difficult, but once you learn it, hopefully then you'll teach other people, because guys, making money in the stock market, it's never going to go away. I don't care if your company closes down, your business closes down. You know, the one thing the government will never close, it's the stock market, because who do you think pays for, no matter which party you believe in, and I'm not getting political here, who puts them into office? It all comes from cash. Where's that cash come from? Wall Street. So what happens if they say, oh, we're going to get rid of Wall Street, we're going to take away all these investment opportunities? What do you think Wall Street will do? They're going to get that person to get voted out of office by somebody else really quick. So Wall Street will never go away. I don't care if your company ever closes, guys. 30 years from now, stock market will still be here. You got a new pandemic and you're stuck in your house again. You know what won't go away? Stock market. It's the ability to actually create money versus work for money and hope that your job never gets shut down. What if you're 80 years old and you still have the ability to look at a chart and buy a stock and sell a stock and do a covered call and get some extra monthly income? How cool is that? It's just wealth creation. It's one of the coolest things I've ever seen that most people are never, ever taught how to do. You're taught to be a good person, but you're not taught to invest. And what you are taught to invest are all the garbage. You know, you're in it for the long haul. I'm not in it for a long haul. I'm in it for a profit. And I'm not going to buy low, sell high, because what's low, what's high? I don't know. I'm going to buy things that are in an uptrend. If I want to get on a freeway going north, get on the freeway going north. Don't get on the freeway going south, because you say, oh, look, this freeway's been going south long enough. At some point, it's probably going to go north. Get on the freeway that's already going north. It'll help you get to your goal much faster. And when that freeway stops going north, get off of it. We'll teach you when it stops going north. That's kind of what it is that we do. Where do you see if corporate taxes get raised? Ralph, good question. It's going to be everywhere. It'll be all over the news because everybody's going to be upset about it. You'll see it. It won't be on my website, but we'll talk about it in the commentary section of the website, but it'll be all over the news. So guys, just get out there, go over here to protectwealth.com/stocks, register for the class. It's only $200 for the 2 full days. And like I said before, if you don't like it at the end of the first day, tell us you don't like it. I'll give you $200 back. I've probably only done it 3 times now in 20 years we've been teaching classes. We have taught classes to hundreds of thousands of people around the world. We are the largest stock market education company in North America. We've done events that have had up to 20,000 people in an arena, we've taught into before. This is what we do. We're actually pretty good at it. But the whole goal is if I can teach you to do this so that you have the ability to, maybe you won't ever be the best investor in the world, but you'll have the confidence to, at the very least, buy the ticker symbol SPY, collect the dividend, and write an occasional cover call once every 4 or 5 months, and you'll outperform the stock market for the rest of your life. It's not that difficult. So even if you have the basics, it'll change your thought process and what's available. And when you start to do that to your kids and their kids and their kids, versus you got to go to school to get an education, to get a job that you might not ever have anymore, it really changes things. When's the next class? I'm on vacation April 10th and 11th. We'll probably have another one in May. I don't have the dates for that just yet. Take your class, but will you be teaching and speaking as quickly as you are now? It's much quicker for me to follow. Thank you, Joseph. I won't be teaching the class. I will be the person that's answering all of the texts, though, as you chat back and forth. We have 2 other instructors teach the class, so there'll be 3 of us in there. I will not be the one teaching, but I will be the one that's answering all the questions. So if you did type up a text like you just did, I would be the person answering that question or feeding it to the instructor to answer it live for you. So, but I appreciate that because yes, I do talk quite fast. You actually had about 2 hours worth of training tonight. Learning is earning, which is very good. Minimum amount for you to manage someone's account. Carmela, we're a little expensive here. We started about $500,000 just because it takes a lot of effort and energy to manage an account. We don't manage a mutual fund, we manage individual accounts. And so we stick with larger accounts. That might fit you, it might not, I don't know. But that's where we're at right now. $25 a month for Income Trader is correct. But instead of just going to Income Trader, I'd rather teach you how to do this so that you know how to use all the proprietary tools in Income Trader. We're recording the 2 days. Some of it will be, but not all of it. Can you share the slide deck, please? The slides, I don't, but these are actually, the whole recording here is recorded, and you can get that from Kendall. He can give the recording so you can look at the information I had on the slides. The reason we don't share the slide deck anymore is I saw other people start copying all of our programs and using our slides. But if you want to copy them, I can't stop you. I'm just not going to give them to you to copy. And I'm not saying you're going to copy them because I apologize if it sounded that way. That's the reason we don't do it. But everything we have is recorded on here. So if you want to manually take a look at them, do whatever you want, you can sure go with it about it that way. So hope that helps. Guys, that's all I have for tonight. Kendall, I think that's what we had. I think you gave me about an hour or so. I always go long when I do this section here because I love talking about this. And I know that you want to get back with your family and stuff, but guys, register for class, protectwealth.com. It's only $200 and it's 2 full days of training. At the very least, you'll come out with knowledge on what's going to happen in the stock market, things for you to do. So even if you decide you don't want to do this, at least you'll see what your broker's doing in your account and why they're doing it. And you'll have a little bit of guidance for them so that you're not always confused about why did they do that? Why did they put me in these mutual funds? Why do I have this right now? How come they're not selling when the market's making lower highs and lower lows and the entire stock market selling off and next year's goals are supposed to be lower than this year's goals? How come we're not moving things around? At least you'll come up with a little bit of information and say, I get that. There's some things, there's always some basic universal truths that all parts of the stock market have to follow. So a little bit of knowledge goes a very long way here.
Super generous offer, Mike. Thank you so much. That's very, very, very generous. We've been working with you for years, and I can tell you, it doesn't get better than that deal. That's the best deal you've ever offered, bar none, for sure. We really, really sincerely appreciate that. To get in, clearly you taught so much information tonight. I love you said, you're here and now you know better. Now you know better. Now you know better. You're going to learn more and more and more as you go through the different workshops and different levels. Just tonight alone, if some of those strategies, you're much further ahead of the game than you would have been had you not came to the class tonight. So everybody, thanks for coming to the class. Mike, super awesome deal. So sounds like we got a lot of interest there. How long is this offer available until?
Probably, I guess, the next probably 6 days or so until we kind of I know it says limited availability, which sounds really weird because it's an online class. But the reason we say limited availability on that, as soon as it's done, it's filled. Obviously, we then create another class after that. But it's because we give you the ability to talk with the coach if you want to. So we'll give you their email access. And they only can handle so many people because they only have so many coaches at any given time. That's why it's limited availability. We can actually teach 10,000 people off of a Zoom call type of a thing. But I don't have that many coaches to talk to that many people. So probably the next 6 days, unless it fills up, then I just have to schedule another one, which I don't have a date for that just yet because I got to go back then and see, do I have, teams available to do that kind of stuff.
You're going to have to learn how to type really fast, Mike, if that's the case. That's
I won't be able to type that fast, no.
Yeah, you can, but that would be hard.
Yeah, I think our biggest class we've ever had was probably 50 people, and we do that on purpose. When we had live classes, we would have, hundreds and hundreds of them, but when it's a Zoom type of thing, just because of what's out there, our biggest class that we usually have is about 50 people. The average one we try to keep smaller than that because I'd like the people to ask questions. I want them to be able to ask questions and I want to be able to answer those questions, because you can't just come up and say, at break time, let me just get some one-on-one and talk with somebody at break time one-on-one if it was a live class. So with online, it's just a little bit different formats. We can teach more people, but we keep it small on purpose so that you have time to actually ask questions and you get those questions answered.
Yeah, no, and it's a beautiful thing. So we love Zoom. It's a great thing, but you still have limited capacity to get through questions. I love that you guys, give them how to fish and teach them how to fish too, both at the same time. And you guys really do that. So I love that. Thank you so much for that great offer. So, okay, so I'll send some recording out to you guys. But again, that offer will go fast. That class, once it's full, it's full. Once the offer's gone, it's gone. So make sure if you are interested to take advantage of that. There are a lot of people on phones right now. So that is protectwealth.com/stocks. That's where you go to sign up. A lot of you can see in the chat screen that did pop up on your screen. There's actually a link there. You can click that link and sign up for Mike's workshop. They're incredible instructors. I've been taught firsthand by Mike, Christine, and Stacy, incredible people. So I can personally say I've learned a lot from you. And Mike, it was fun last time we had a workshop. We had one of your students jump on. This was totally not scripted. We didn't ask for this. We have always feedback, people who jump on. We had one student who said, literally last year, they said they made over $1 million trading last year using trading. I'm not kidding, dead serious. That blew my mind, and that happens all the time. Someone else made over 100,000 last year. You can't ever make claims. I know that, but that's
we try. It was I heard about it. I think you told me about that because I was given the class and somebody mentioned that. We try not to ever say, hey, here's how much money you're going to make. You're going to be doing this, you're going to do this, you're going to make this much money type of stuff. And here's, we're going to make 18,000 million trillion %. And hey, I just did this one trade and made 85% in 2.5 minutes of. We try to do that because those are unrealistic claims. But if I can just teach you to do a better job than somebody else is doing for you and not pay them $150,000 over the next 20 years to do what I just did in an hour, and you do it once a year, why would you say, I think I stuck to that $150,000? I'd rather just give you the basic information. From there, you say, well, now I want to learn more. I also want to be able to do this. Well, now you can say I can start to make some of those decisions, but let's get the basics out of the way first. Yeah.
Oh, the
So,
eighth wonder
yeah,
of
but
the
yeah,
world is
I heard,
compound interest.
yeah, I heard about that. I've got hundreds of emails about people sending me, "Hi, Mike, I just made this much money. I got two more today." Christine actually just read one to me this afternoon. We had a little conference call about somebody who'd made, and you know who it is. If I told you who it is, you know exactly who it is.
Love it.
Yeah. And so, but they were just saying that my whole life has now changed. I don't care if my husband dies because he's getting older, because I have the ability to go ahead and live without him. That's what, and you know who it is. And I told you, I'm not going to tell you who it is, but
Sure.
yeah.
Well, you know what? See, we love it. And that's why we've been working with you guys. Gosh, we've known you at least 15 years, probably more. I know with Don, probably even more. So kind of fun, Mike. We appreciate it very much. You know, a lot of happy people, you know, and that's a great deal. So thank you so much for that deal. We'll send you guys an email, keep you posted on updates, but sign up for Mike's class. What were the dates again? April
10th and April 11th.
Okay.
On the classes. Yeah. April 10th.
Friday, Saturday, you said, or Saturday, Sunday?
They're always Saturdays, Sundays.
Smart.
Yes.
Okay, great.
Yeah. Saturday and Sunday. Sunday we usually end around 5 p.m. on Sundays, but we say 11 to 6 just in case we won't go along. But Sundays are always 11 to 5.
Okay. And the nice thing is, you know, like Mike said, if you can't absolutely are out of town, can't from your couch, you can watch this from your couch. If you can't make that, there are other dates available down the road a little bit too. But
yeah, you can still go ahead and register today if you'd like. You still get access to the website. I'll still send you an hour-long training on how to write some cover calls, you know, some basic stuff. But then you can kind of gives you a chance to prepare a little bit before the next class pops up. And so at least you're on the website and you can kind of play around and learn a little bit. And then when the next class does pop up, which will probably be 4 weeks later or so, I don't have a date just yet. I have to ask the teams, when are you available to, do this? Then we'll just put you in that class instead.
Well, and so the classes are available, they're ongoing, but the offer isn't always. And so I know there's a special offer for our group.
The offer changes based on what I put into the class. Yeah. And so based on what I put in the class, it changes. Could go up to $1,000, could go to $1,500, could be $400. So I always try to do different items based on what you guys need. Don and Ken will say, hey, here's where a lot of our students are coming from right now. Here's what other things they're doing. And so I try to make things that are kind of tailored to what I think your needs might be, based on what Kendall tells me that people are coming to the classes with. So
well, it's true. Yeah. Because the recession and the COVID recession, things like that, people are struggling. It's the best deal you've ever offered. That is 100% true. So we appreciate that. It's very generous of you guys. Thanks, Mike. And I don't think you talk too fast. I talk too fast. So I love it. Thanks, Mike.
All righty. All right, guys. Thanks for being here, guys. I appreciate all of you. Thank you.
Thanks, Mike. We appreciate it very much. Anybody else you have questions, give us a call. Sign up for that workshop, protectwealth.com/docs. And if not, we'll see you guys soon. Thanks again, Mike. Have a great night.
All righty. Thanks. Bye-bye.